Welcome to helping you build wealth through real estate, brick by brick. I am Nico James-Bock, founder of the CondoWiz Group and broker with Keller Williams in Toronto. Today, we're connecting the dots between the GTA housing market based on the December 2025 market stats, interest rates, jobs, inflation, trade risk, and Ottawa's latest policy moves so you can understand what actually matters as we navigate the rest of the winter market and head into the spring market. GTA housing market December 2025 reality check. Headlines first. Prices at lowest levels since January 2021. Sales lowest in 25 years. December inventory highest in 17 years. Market conditions firmly favor buyers in most pockets. Let's start with the GTA housing market. December 2025 ended colder than anyone expected. Prices are now at their lowest levels since January 2021. Annual sales are at a 25-year low, and December inventory hit a 17-year high. This is no longer a debate. We are in a buyer's market for the most part. The key takeaway here is this isn't just a pricing issue. It's a confidence and affordability issue layered on top of uncertainty. Employment inflation and mortgage rates. Unemployment rate rises to 6.8%. Youth unemployment climbs to 13.3%. Full-time employment is up, part-time employment slipping. Mortgage rates likely near cyclical lows. What this means? The labor market is softening without collapsing. Unemployment rose to 6.8% and youth unemployment jumped above 13%. Full-time jobs increased, but part-time work fell, which tells us households are under pressure. Inflation is cooling, but not defeated, and trade-driven price pressures remain. The Bank of Canada is boxed in. Rates may not fall much further, but hikes also look unlikely in the near term. Waiting for dramatically lower mortgage rates is becoming a risk. Immigration, housing, and jobs. The headlines again: population growth remains strong. Housing supply still lags demand. Job growth uneven by age and sector. Immigration continues to drive long-term housing demand, but it does not automatically create affordability. When population growth outpaces housing supply and job creation, pressure builds. Incentives alone won't fix this. Without meaningful supply, especially entry-level housing, affordability remains strained despite falling prices. Let's look at office recovery and return to work. Let's break it down. Definitions first. Class A offices are newer, high-quality buildings in prime locations with top amenities. Trophy buildings are best-in-class landmark towers that attract major tenants. Class B and C buildings are older properties with fewer amenities. Office markets are quietly stabilizing, but the recovery is uneven. Class A buildings, meaning newer, high-quality offices in prime locations, are seeing declining vacancy rates. Trophy buildings, the top-tier landmark towers, are now near 3% vacancy in Toronto. Meanwhile, older Class B and C buildings remain over 25% vacant. Major employers are enforcing 4 to 5 days a week in office, which is rebuilding downtown confidence and supporting urban housing demand. If we look at trade, CUSMA, and housing confidence, we look first at the headlines. Risk of CUSMA, that's Canada, US, Mexico agreement, renegotiation or withdrawal. Potential return to WTO tariffs. Steel, aluminum, and auto exports already have been hit hard. The lowdown? WTO, which is the World Trade Organization, tariffs are the floor plan for global trade when special deals fail. They're boring, technical, and absolutely critical. If trade agreements wobble, WTO tariffs quietly step in and reset the cost structure across the economy. Trade uncertainty is a silent drag on housing. If the US withdraws from CUSMA, Canada faces higher tariffs, supply chain disruption, and slower growth. Even the threat of this rising costs reduces hiring and freezes investment. Housing markets hate uncertainty more than high interest rates. And right now, trade risk is undermining confidence. We look at the Fed's first-time buyer policy push. The straight facts are GST eliminated on new homes up to $1 million for first-time buyers. RRSP withdrawal limits increased to $60,000. And 30-year amortizations for new builds. The lowdown? Ottawa is trying to stimulate demand by reducing upfront costs. Eliminating GST on new homes up to $1 million could save buyers up to $50,000. RRSP withdrawal limits are rising and longer amortizations lower monthly payments. These measures help cash flow, but without new supply, they risk pushing prices rather than restoring true affordability. Key dates to keep in mind that will shape the rest of the winter market and the spring market. January 19th, we're getting the inflation report. January 28th is Bank of Canada's rate decision. February 6th is the employment report. And February 27th, we have the Q4 GDP numbers. What this reveals: markets move on expectations, not headlines. Inflation, rates, jobs, and GDP over the next 6 weeks will shape buyer psychology heading into spring. Stability, not stimulus, is what unlocks sidelined demand. This is a positioning market, not a panic market. Buyers who act before confidence fully returns gain leverage. Sellers who price realistically will win. Investors should stick to fundamentals. Wealth is built by moving early, not emotionally, brick by brick. If this episode helped you cut through the noise, don't keep it to yourself. Like it, leave a comment with how you're reading the Toronto and GTA market right now, and share it with someone making real estate decisions in 2026. The more we elevate the conversation around confidence, risk, and strategy, the better decisions we all make. Ciao, ciao.